Direct expenses are the expenses other than direct material cost and direct employee cost, which are incurred to manufacture a product or for provision of service and can directly be traced in an economically feasible manner to a cost object. For example, royalty paid or payable for production or provision of service, hire charges paid for hiring specific equipment, cost for product service specific design or drawing, cost of product or service specific software, other expenses which are directly related with production of goods or provision of service. The above list of expenses is not exhaustive, and any expenses which are directly attributable to the production or service are also included as direct expenses. Direct expenses are measured at invoice or agreed price, net of rebate or discount, but includes duties and taxes for which input credit is not available, commission, and other directly attributable costs. In case of subcontracting, where goods are manufactured by job workers independent of the principal entity, these, that is, direct expenses are measured at agreed price. Where principal supplies some materials to the job worker, the value of such materials and other incidental expenses are added with the job charges paid to the job workers. The treatment of direct expenses is in the part of prime cost. In case where the direct expenses are paid in lump sum or one-time payment is done, the cost is amortized over the estimated production volume or benefit derived. If the expenses incurred are of insignificant amount, that is not material, then it would be treated as overhead. Techniques of costing. Uniform costing. When a number of firms in an industry agree among themselves to follow the same system of costing in detail, it is adopting common terminology. The advantage of the same is comparison between the performance of each firm with another or with the average performance in the industry. It is also useful when tax relief or protection is sought from the government. It is also possible to determine the cost of production of goods, which is true for the industry as a whole. Marginal costing. It is ascertained by differentiating between the fixed and variable cost. It is used to ascertain the effect of changes in the volume or type of output on profit. Standard costing and variance analysis. Standard costs are predetermined and subsequently compared with the recorded actual cost. It is suitable where the manufacturing method involves production of standardized goods of repetitive nature. Historical costing. It is the ascertainment of cost after they have been incurred. This type of costing has limited utility. Post costing. It means ascertainment of cost after production is completed. Continuous costing. Cost is ascertained as soon as the job is completed or when the job is in progress. Absorption costing. It is the practice of charging all costs, both variable and fixed, to operation processes or products. This differs from marginal costing where fixed costs are excluded. Direct costing. Direct costing is a specialized form of cost analysis that only uses variable costs to make decisions. It does not consider fixed costs, which are assumed to be associated with the time periods in which they are incurred. Situation and method of costing. Costs are directly charged to a group of products, batch costing. Nature of the product is complex and method cannot be ascertained, multiple costing. Cost is ascertained for a single product, unit, single output costing. All costs are directly charged to a specific job, job costing. Costs are charged to operations and averaged over units produced, process costing. Industry or product, cost unit. Chemical, liter, gallon, kilogram, ton, etc. Oil, barrel, ton, liter. Brewing, barrel. Cement, ton per bag, etc.